From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. This is Tony Fratto with the HPS Macrocast. Got me in the very festive New York City, ready for the holidays. John Fagan and Brendan Walsh from Markets Policy Partners in the DC studios. As our last episode, our last live episode of 2019. I'll have a note later about what we're going to do next week to close out the year. But guys, here we are. Almost Christmas week. It's a tough week for the president in that he became the third president impeached in the history of the United States of America. We'll talk about that a little bit. Got a little bit of good news yesterday, though. Got the USMCA deal done, and we'll talk about the data a little bit. But U.S. economy still chugging along, really, pretty strongly.
Yeah, that's certainly that's all right. It's been a placid pre-holiday period here, and clearly getting the Phase 1 deal, at least not signed but finalized to a great degree, according to both the U.S. and Chinese officials. That's been a huge tailwind for the market all year. The expectations for that and having those validated has given us a very pleasant pre-holiday drift upward in equity markets, and it's a good way to end the year.
It's not the way we were ending the year last year, in 2018. There was a lot of nervousness going back 52 weeks ago. Markets were taking a dive, was unsure.
Yeah, it was down 25%. Yeah,
25% was significant sell-off in the markets. Lack of clarity or disappointment in the direction of the Fed at that time. Concerns about the inverted yield curve.
Yep.
That it was either hints of it or it was coming. We eventually did see it during the year. But yeah, what a difference a year makes.
No question about it. The as you alluded to, the big stories for the year of 2019 were really about the back and forth, the U.S. China trade brawl, and expectations that a deal would be finalized and hammered out in some way, shape, or form, despite all the drama. And the other big story of the year has been the Fed's pirouette from this time last year. They had put a rate hike on the board, their last one of the tightening cycle, and the markets had reacted, as you alluded to, Tony, in a very negative, very volatile fashion. And
then they gave guidance that they expected to do 4 in 2019.
Yeah, I remember at the time I was talking with Brendan, and just after they hiked, and the market was exhibiting a virulent reaction to the downside, the equity market. And I remember I was on the phone with Brendan, and I said, I don't think that Chair Powell is ever hiking rates ever again, ever. And there was a note of hyperbole in that statement, but at the last press conference, he basically told you that. He said, we're not seeing any wage pressure, that we have to rethink what we think is the kind of the low end for the employment sector. Yeah, and when we do flash back to this time last year, what we were telling our clients and readers was that the Treasury market and the futures markets were really already ahead of the Fed. They were the futures markets were pricing in, even as the Fed was hiking this time last year, the futures markets were pricing in rate cuts in 2019, and that proved to be prescient, and it certainly was the way that the Fed executed a somewhat abrupt retreat from its hiking and tightening cycle, both on the interest rate front, but on the balance sheet front as well. And we flash forward to where we are right now, and interest rates are 75 basis points lower than they were. And at this time last year, the Fed, as Brendan said, Chair Powell has told us that it's the threshold for restarting rate hikes is extremely high. He said, I think a very significant uptick in inflation. I think
he said, they're not. It's not enough to see the whites of inflation's eyes. Like you need to poke inflation in the eye with your finger and touch it. Seeing it isn't going to be enough. You better feel it too.
Right, and the reduction of the balance sheet of the Fed's balance sheet that had been in train for a long period of time, and the Fed halted that and has now reversed it. This is the Fed is not characterizing this re-expansion of the balance sheet as quantitative easing. It's characterizing it as a technical adjustment, but the view from the markets is it's a little bit hard to tell the difference between the two, and certainly the liquidity provisions from these restarted asset purchases alongside the liquidity operations that the New York Fed is putting in place to try to tamp down any funding market stress through year end, like we saw in September. These are big numbers, as we said last week. It's $500 billion of liquidity being offered into the system.
And then there's actually many on Wall Street are calling for more liquidity.
Right. Yeah. And there's no reason they can't do more.
Yeah. Yeah, it seems like we've been sort of testing, been testing it for a long time, and the testing can go on. You probably, there is no reason not to deliver more liquidity if you're not seeing that impact. There's no reason not to do it.
Exactly. This is the one scenario where throwing money at a problem actually solves the problem.
Yeah. What can we say about that? That dance with the yield curve mid-year.
Yeah, that was on the sort of honorable mention of big topics for 2019. The inverted yield curve, the crazy inverted yield curve, as President Trump tweeted at the time, is certainly up in the top 5, probably. And,
it became a search term on Google, one of the kind of the trending.
Amazing.
Right.
I was getting T-shirts made.
Yeah. The idea, and just to roll the tape back for the inverted yield curve is typically there are different parts of the yield curve segments you can look at, but the 2-year to 10-year portion of the Treasury yield curve is typically what is used, is the most commonly referred to as the yield curve, the generic term. And the inverted yield curve is when the yield on a 10-year bond is less than the yield on a 2-year bond. It doesn't make a lot of sense. It only makes sense if you're expecting the economic outcomes to be appreciably worse in the longer term, or and sort of a corollary to that, the Fed is overly tight in the front end, and that was and it's been a very dependable signal of a recession with a lag of about a year once the signal comes through. Now, as we debated, there are a lot of arguments as to why the yield curve might be a little bit distorted. The gravitational pull from negative interest rates in Europe and Japan in particular, the regulatory demand, and
banks have to hold a lot more high-quality assets, and Treasury is the highest one.
Right. And at the time, there was a lot of concern about the trade situation. The Trump administration had re-upped the ante against the Chinese. The deal in May had fallen apart, and President Trump had applied a whole new set of tariffs in early August.
Right.
And so
you're right. The concern wasn't just U.S.-based, but it was global. We weren't talking about just a U.S. recession, but because of everything that was going on, the whole global economy.
Absolutely. And that rush to a safe haven obviously benefited the 10-year yield to a great extent.
And just to give the listeners a kind of an understanding of how big these moves are. So back in 2018, the 10-year had a yield of close to 3%. And kind of over the summer when we were at of 2019, when we were really, really kind of worried about recession, it was 1.5%. So that kind of move is somewhat unprecedented. But it's also understandable how the yield curve became inverted, because the long end, the 10-year, moved down so much. And the 2-year, which is the shorter duration, moved much less.
We get lots of questions from our clients and readers about whether this it was a very flash in the pan, a very brief inversion of the 2-year and 10-year, whether that's a good signal, all else being equal. And the sort of rule of thumb is that an inversion to give a real and dependable signal, most market participants think the inversion should last a quarter, 2 quarters, something like that. This certainly didn't do that. But there's also another issue that that we talk about, which is, the economists, what they call Goodhart's law, which is when
this is good.
Yeah, when an indicator becomes a target, it ceases to be a good indicator. Is what the law states, and it's pretty clear that based on the Fed's commentary, that the 2-10s yield curve was to a great extent a target. Unlike in 2007 when it was a curiosity and certainly wasn't talked about in the way it wasn't featured, it wasn't in the spotlight or making headlines. It was an anomaly that most people didn't really.
And it was totally dismissed back in 2000.
Right, but 2008 brought everybody to school and everybody had to sharpen their pencils on these recession harbingers, and the yield curve was is chief among them. And so when it did invert, that was certainly a time when the Fed seemed to be intent on disinverting the yield curve. And you could say that their policies were targeting a disinverted yield curve. And by Goodhart's law, then maybe the yield curve isn't a good indicator anymore.
Right. Even going back to, remember we were talking about the 100-year bond, and we talked about it on the podcast. And then that day, the Treasury came out and talked about it. Talking about a 100-year bond is a good way to make like the 10-year
the 10-year yield rise up. Yeah, exactly. And the Treasury Department came out, the conspiracy-minded among us might think that was designed to perhaps hoist the back end of the yield curve up a little bit. I haven't heard a whole lot about the 50 or 100-year bond.
It kind of fell off
recent days. Anyway.
I'm happy to not hear it. Not hear it too. To be honest with you. So that was one of the there were reasons why we saw that, and we had there were good reasons why the markets were reacting when they were. We talked about the Fed. We talked about inverted yield curve. Those signals. The other things that were hanging out there. If we just take a couple minutes on a couple of these are Brexit. So Brexit was a thing out there. It still is. We got a lot of clarity on it, and we got a lot of clarity on the trade front. And so I think what I want to do is I want to sneak a break in here, and I want to talk about those are the things that caused some disruption.
Yep.
I want to get a break in here, and then come back and talk about the things that we're still kind of looking at that resolved some of the disruption, and see how we think about them going forward. So this is Tony Fratto, HPS Macrocast. We'll be back right after this break.
Every 2 weeks, HPS measures U.S. adults' feelings and expectations for the economy. The Microsoft News Civic Science Economic Sentiment Index, powered by HPS, accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through HamiltonPlaceStrategies.com.
We're back on the Macrocast, guys. So on the trade front, which I think we have to talk about it. We talk about it on every single Macrocast for good reason. It's been eating up a lot of our time, a lot of the attention, and for all of us trade nerds, it's been like maybe the greatest year ever to talk trade. USMCA gets its vote in the House yesterday. Big vote. Not unexpected. I think once, for being, objective on this, once, Bob Lighthizer caved to his own desires rather than the desires of traditional free market Republicans, and the desires, and instead, aligned with, Senator Brown from Ohio and other traditional protectionists, and gave in to them, knowing that Republican votes weren't going to go anywhere. They were going to stick with Trump. Democrats were going to have the cover to vote for it. In fact, they're running around calling it their bill. So that was sort of a fait accompli. And I think despite the fact that Senator Toomey in the Senate is going to try to fight on MCA, there are elements of the deal that he has problems with, and I have problems with too. But I think it's pretty clear the Senate's going to hold true to form, and that the bill, the USMCA is going to pass. So we're going to have a replacement for NAFTA. And we don't have to go into the details of it. We've done a lot of that. I think that's going to get done. China, some resolution on that also. with we think the completion of the phase one deal. My prediction that it's not happening is still hanging out there,
well,
and because we haven't actually seen paper on it yet, but I think it's pretty clear it's gonna happen. But you never know, right, until that story's sold. But certainly, a lot of confidence that some of the tariffs are going to get rolled back, and on the trade front, at least, even though we're still seeing lots of tariffs on about $360 billion worth of products with China, still have steel and aluminum tariffs out there. You get the sense that it's not going to get worse, and that's been a relief for markets, hasn't it?
Yes, totally. USMCA, while very important for the North American economy, didn't really show up in markets, maybe a couple individual stocks, but it wasn't really a market mover. But the China and U.S. trade tariffs, that massively moved markets in 2000, both 18 and then 19, where any time that negative news came out, especially equities went down a lot. And then the Trump administration got very good at, talking it back up. But in the end, I think the president needed to move on to run for president. So we get a deal. The questions now are, China's made some promises, relatively large promises, to buy agricultural products. We'll see whether there's, enough products and demand to buy it. But that's a worry for another day. So I think the markets are, content with moving on. And we've had 12 now months of global monetary easing. So, you see kind of into year end, the market's going up. But as kind of 2020 reports are coming out from Wall Street in terms of outlooks, especially for the first half of the year, it's pretty kind of risk on, rosy appetites.
Yeah, the expectation that, and we've talked about this before, is that the brinksmanship tactics, the tariff threats, that sort of thing was a 2018-2019 motif in the U.S. trade negotiations with China. 2020 is very likely to shift into a much more placid, behind-the-scenes, slow-moving.
Yeah.
Very few people on Wall Street expect phase two to be really anything substantive before the election. These are even harder issues. Phase one was hard enough, and this was the low-hanging fruit. This was the layup. Mm-hmm. But yeah, looking back at 2019, certainly there was a degree of there were always going to be some spills, thrills, and chills with the pressure negotiation tactics that the Trump administration employed. But when I think that we characterized it when we were talking about the trade issue in a way that most people on Wall Street understood it, which is the Trump administration was sort of tactically unpredictable. You didn't know when they were necessarily going to, hit the Chinese with something, when the tweet was going to come out, but strategically predictable, which was they're going to do pressure tactics, get as much as they can, and then sign the deal. Sign the deal before things really go too far. Before
it starts affecting politics and approval ratings here in the United States.
Right, and that was the consensus that formed in the first quarter, really early in the year, and it really held through, and it kind of comforted that default assumption, comforted investors in those moments where the Trump administration was firing off another tariff broadside.
Yeah. Now, like I said, we are still, we still have all of these tariffs hanging out there. I mean, we shouldn't neglect that. I mean, it's $200 billion of products with 25% tariffs, another 160 odd. I can't remember if I have the numbers right, and they change actually, obviously, as prices change.
But the markets were very worried about those December 15th tariffs on consumer goods, and the fact that didn't happen.
Yeah, instead of going to because those don't go to the inputs to goods, where there are more opportunities to absorb those costs and defray them or ship them around.
Right, especially the agricultural stuff. The U.S. Treasury was writing pretty big checks to those guys.
Yeah, exactly. So so that was there are lots of bullets in the gun, but that was a bullet dodged.
Yes,
maybe two bullets dodged, and so if you could feel better about that. The other big item that was a shadow on the economy and markets for the year was Brexit, and had the big election finally with for at least a few days sense that, Brexit is going to mean Brexit, and it's going to happen on January 31st, and a presumption that there will be a deal that Parliament will be able to support. And then this week we're back at, with the risky possibility of hard Brexit again. Is this a head fake by Boris Johnson, or where are we?
I know. Say it ain't so, Bojo. We're back to hard Brexit risk. It was a brief respite after the decisive election result last week, and that gave the pound had really gotten a tailwind starting from August, when it became pretty clear that after the garden walk with the Irish Prime Minister, Boris Johnson might be centering on a deal. And the fact that it passed it passed Parliament and then was ratified and really cemented through that general election that we had last week gave, it seemed to almost not close the book on it, but Boris Johnson has now come back and is seeking to impose a hard deadline for the transition period, which is the post-Brexit negotiation of a trade deal and all the different trading arrangements with the EU. He is putting that. He's trying to put that at the end of December next year. That is an extremely short timeline for this kind of wide-ranging and substantive negotiation. I think I saw a statistic that said that the EU-Canada trade deal took 11 years.
That's right. It did, and it did. Now there were other reasons. Yeah, there were other reasons for that, but that's why. Like all this talk about going and quickly getting a trade deal done is just silly, right? I mean, it took Canada, Europe, Canada, UK discussions are going to be they alone are going to be very complex, and they already have trade agreements,
right? And so the main barometer, as we've seen time in, time out, the main barometer in financial markets for the fortunes of Brexit and the fortunes of the UK is the pound. The pound was up over 9% from its August low against the dollar as Brexit, the view to an orderly Brexit began to crystallize. And just this week, not just the re-upped hard Brexit risk, but a string of very downbeat and dismal UK economic data has come out and taken the pound down. It was almost down 2.5% as of yesterday. It's stabilized today, but this is the challenges for Brexit obviously are not over, and we've just announced the new successor to the governor of the Bank of England. Mark Carney is finishing his tenure at the end of January, and will be succeeded by Andrew Bailey, who was basically the odds-on favorite, a steady hand, a consensus candidate, but. Our markets have about
no longer outsourcing their central bankmanship.
Right. And markets
Canadians
still have about 50-50 odds of the Bank of England having to go back to the rate cuts by the end of next year.
Yeah. Although I should say something about Mark Carney, a really remarkable person, really terrific person, and I think was a very successul central banker, and did a terrific job as the head of the Bank of England. We'll always call him a Canadian, but he actually became a UK citizen.
That's right. Do you know what his next act is?
I don't know.
Well, he can do comedy. He's like real world funny,
he's
one
of the funniest
funny.
people. Yeah. He's a natural for it. Econ comedy mostly, but he does other comedy too. Yeah. The last sort of dark shadow on 2019 is going to extend, like a number of these will, into 2020. But had news this week is on the impeachment front. There aren't a whole lot of economic and market consequences for it. I think actually, as they showed by pairing the USMCA vote, getting budget deals, progress on budget deals done, and having the impeachment vote all in the same week, that there's an ability to compartmentalize some of these opportunities, and there are certain aligned interests on getting some of these things done. But it was a historic week that way. I mean, Andrew Johnson and President Bill Clinton, the two previous presidents who have been impeached by the House of Representatives. Now President Trump will wear that, be part of his biography forever.
I'd be curious, how do you think it plays out in the Senate in terms of timing? And, do we actually get a trial, or is it just a quick vote and we're done?
No, there will be a trial. There has to be a trial. What the contours of the trial are an open question, and we're actually in a mini dispute over this right now. So we say that Trump has been impeached. Technically speaking, he hasn't been impeached until the Senate has been notified that he's been impeached, and Speaker Pelosi has been withholding the notification to the Senate that they have in fact impeached the president, while she, I think it's a long shot, but an attempt to have some impact on the rules of the Senate, to see if their process will include some witnesses or and have a more thorough trial rather than a speedy vote. And look, I mean, the irony is all through the House impeachment process, the White House and Democrats or Republicans were clamoring for wanting to bring witnesses and call witnesses and have a trial, and that's not, impeachment isn't the trial. The trial's in the Senate.
Yep.
So now we're going to be moving to the trial in the Senate, and there is reluctance to actually call those witnesses. So we'll have a little bit more drama on that. Where I think we'll be coming back. I suspect we'll be coming back in the new year with that work, and it's going to go on a while. Where it has another impact, though, is that the senators are required to be present in the Senate during that the trial proceedings.
Yes,
and a number of those senators are running for president right now. Yeah,
huge advantage for Joe Biden.
Yeah, big advantage for Joe Biden. And maybe some of the lesser candidates.
Yeah,
Pete Buttigieg is already running pretty strong in Iowa. Will not have to be out there tussling with Elizabeth Warren and Amy Klobuchar, Bernie Sanders. So yeah, it's advantages to them. We'll see whether they make the most of it. Why don't we take our last break here, and we'll come back with some outlook on 2020. And you're listening to the HPS Macrocast. We'll be right back.
Hamilton Place Strategies is an analytical public affairs firm based in Washington, D.C. Learn more at hamiltonplacestrategies.com or follow us on Twitter at HPS Insight.
And we're back. Last segment, guys. The next time we're together recording a live Macrocast, it will be 2020. So looking ahead to next year, what's on your mind?
Well, we're certainly everybody on Wall Street gets the chance at the end of the year to make prognostications that are turn out to be wrong about the coming year, and so it's we'll we'll take our turn to be wrong too. But first, let's characterize the basic consensus. Obviously, so many of the year ahead forecasts are basically an extrapolation of trends that are already in train. And so it's pretty hard looking at the gaudy returns of the S&P 500 this year. We're up 28% on the year. Yes, that's a little bit flattered because the market was down a lot in December of last year. And so it backed off a little bit so it could run up from the highs of 2018. I think we're up like 10% or 11% or so, something like that. But it's still great year. And so characteristically, equity analysts and strategists are typically looking for a continuation to the upside. The idea that low interest rates, extremely easy monetary settings, the Fed pumping liquidity into the system to the tune of $60 billion a month, although it's a technical adjustment, still is a tailwind for sentiment. And corporations, we saw corporate earnings looking pretty healthy last year, better than expected, although not great. Expectations are maybe a little bit higher for next year, but
I just read a report that basically all of the move in the S&P 500 was explained by earnings per share. It really wasn't just a monstrous multiple expansion. It was pretty good earnings.
And the expectation for the consensus expectation is for a modest reacceleration of growth in the coming quarters with all of this easing that we've had in the pipeline from major central banks, plus a little bit more clarity and détente on the U.S. China trade front. It's a pretty easy case to make that we get a little bit of a cyclical boost coming into the new year with a couple of good quarters, and that's a pretty delightful scenario for equities. Really, the only argument is about the degree of bullishness, and of course, there are always some bearish outliers. When we look at the currency space,
a lot of people are very bullish on Europe, just kind of the catch-up trade.
Yeah, I feel that way. Yeah.
And emerging markets, Europe. Japan, the U.S., the debate about whether the U.S. can continue to outperform and looking at some of these, as you said, catch-up plays.
Yeah, emerging markets also, especially as you're going to talk about the currency with the Fed kind of on hold. That's a pretty good scenario for a lot of emerging markets corporates.
Absolutely, yeah. The expectation in the realm of foreign exchange and currencies is that the dollar is pretty steady to slightly moderately lower.
Yep.
Moderately weaker. It's, again, that sort of cyclical catch-up in the rest of the world as Europe, economic data in Europe looks a little bit friskier, a little bit better, and the expectation that the trade fight-induced manufacturing recession probably eases to some extent in the coming year. That's all pretty good for the outlook overseas. Maybe relatively less positive for the U.S., although still positive. Creating this kind of catch-up dynamic in which dollar weakness isn't really dollar weakness. It's sort of a little bit burst of strength in the peer currencies. And that works very well for emerging market currencies as well.
Yep.
But certainly, the debate really is most. Is the widest dispersion of calls really is in the Treasury, in the rates space, and it's we're going from you're seeing estimates that are up in the 3% range for the 10-year Treasury yield for next year at some point, and as low as 1.2% for the crowd that are calling for a recession by the end of the year, and then and then there's the right down the fairway crowd that see it topping out in the sort of 2.5 range where it's comfortable and steady, but no great shakes, and those align with very different economic expectations.
And just for reference, as I said earlier, we were last year we got as high as 3%, we got as low as 1.5%, and now the 10-year is at 1.93%. So it's come back a lot.
Yeah, and really in this sort of quiet year-end period, the only really directional move we've seen is yields coming up.
Right.
And obviously traders are kind of leaning into this, trying to get a little bit of a head start on this reflation trade. And a sense that, the Fed has really told us that they're going to sit back and let reflation happen instead of hiking into it, maybe in the way that they did in 2018. And that would be a pretty different dynamic. It's a very hot thing to be buying the Treasury inflation protected, the TIPS, the inflation protected Treasuries. It's kind of the kind of hip position coming into the next year to be bullish on inflation. I think that's there's certainly good justifications for that. One other thing that seems to be missing from my mind, for the sort of global reflation, a muscular global reflation, really is about China. You can envision a global reflationary episode that doesn't really involve a reacceleration of China or much stimulus happening in China, but it's a much harder case to make. If China is, the sort of bullish case on China next year is the trade war has kind of come off, is in a truce, and so so magically their manufacturing is going to pop back up. But that's a premise I think we can, that's a testable premise. And the really structural headwinds that they have, China's made news for all the wrong reasons this year in a lot of different cases, and certainly seeing increasing corporate defaults and some pretty dismal domestic numbers. Stimulus levels aren't really where some people expected them to be, and the noise coming out of Beijing and the economic policy makers' fears really is about a very sober message, downgrading the growth expectations, talking about increasing challenges. That doesn't necessarily fit all that well with the big global reflation story next year.
Yeah. Anything else, Brendan? Anything on that you want to point to?
No, those are kind of the big ones. I suppose also what I'd look for in 2020 is, the markets. We've had a big, long expansion. You've had a lot of technological advancements, and money's really cheap. So I think you'll see a lot more M&A, especially amongst some of the big companies.
Yeah.
I think one of the things I think one of the things that would be really interesting is if we do get this, if we do get a meaningful reflation trade, oil prices are creeping up, and if we get this inflationary impulse that the Fed and global central banks have been trying to gin up, it kind of creates this image where the Fed is goading inflation. Come on, get up. And if inflation actually, gets up off of its bar stool and rolls up its sleeves, is the Fed, how's the Fed going to react?
It'll be interesting, for sure.
It's definitely a place we haven't seen, and would change a lot of. An inflationary, a return of meaningful inflation would change the dynamics very swiftly, potentially.
The one thing I'm going to point to, and I'm not going to say where it's going to be and what it's going to be, and we could think about who some of the likely characters are. But you guys may not be aware of this, but 2020 is an election year also. So there's an election year next year, which in and of itself is not. It can be disruptive. We're going to see that the country's pretty divided, and at some point it's going to be a choice between Trump and a Democrat, whoever it is, and so we'll be following that and see how it goes. Later in the year, we'll be talking about the implications that might mean for wildly different directions on policy, regardless of who the Democrat is. But one other thing that we have some experience and know that happens is that because we get distracted by these very, very big elections, and they capture our attention. By the way, they capture the world's attention too. Everywhere you go in the world, If you're an American, people will ask you about what's going on with the election. So it's a big deal. Our enemies know that also. The North Koreans know that. The Russians know it. Terrorists know it. They know that we're distracted. We may have our eye off the ball, and they tend to take advantage of it. It was in 2008 that President Putin invaded Georgia. We had later in his what he was doing in Ukraine. They tend to revolve around when America is distracted, they take advantage of it. So I don't know who it's going to be or where it's going to be, but I would, if I were in markets and I was paying attention, I would be thinking about those things and looking for the seeds of that.
That's a great point.
Yeah. So look, we'll leave our outlook there. I'm just going to say, as we close out, I want to thank all of you listeners for downloading and subscribing to the first season of the HPS Macrocast. Next week, you'll hear a pre-recorded episode of the Macrocast on December 27th. We'll release it. It'll be a little bit more personal. We're going to talk a little bit about the way we think about, how we learn economics, how we got to be where we are, which I always really enjoy doing for especially, younger listeners are trying to, chart their path in this world and think about what they want to make with their careers. It's always nice to hear how other people did it. We're going to take a break on January 3rd, but we'll be back with a live episode on, another mother of all jobs days. It'll be later in the month. They pushed the jobs day out in January because January 3rd, is just too close to people are still hungover on January 3rd. So we'll have the Jobs Day edition of HPS Macrocast on January 10th, and we're really looking forward to starting season 2. We want to thank all of you. It's a lot of fun for us to do it. We want to thank all of our guests, our regulars like Matt McDonald, who's a regular host of HPS Macrocast, especially on Jobs Days. And we look forward to a really exciting 2020 with lots of juicy macro monetary policy issues to dive into. So Tony Fratto, Hamilton Place Strategies, John and Brendan, Markets Policy Partners, have a wonderful holiday, both you guys and our listeners. We want to thank also, we haven't done this all year, but this the team at HPS, who is our production crew, is really terrific. They rotate on it. They do a great job. So we will see you in the new year. Thank you. Have a terrific holiday and a wonderful new year.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @TonyFratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.